Welcome everyone. Today I am going to discuss with you the U.S. residency trap in relation to substantial presence test. Why global earners are accidentally becoming U.S. tax residents and how to protect your wealth from worldwide taxation. There is a big misconception. A taxpayer may think because they don't live in the U.S., they assume that physical residency is the only trigger. In reality, the IRS uses a mechanical formula that can catch you even if your heart is in another country. One wrong filing can lead to minimum penalty of $10,000 per year, plus back taxes on global income you thought you were exempt. So in Module 1, we're going to discuss who are considered residents versus non-residents. This module is to frame and understand the critical fork in the road that defines your tax relationship with the United States. So who are considered resident and non-resident for U.S. tax purposes? So if you are a U.S. citizen, irrespective of where you are residing, or if you are a green card holder, again, irrespective of where you are residing, you are considered a resident for U.S. tax purposes. There's also another test. It's called the substantial presence test that if you meet, you can also be considered a U.S. resident for tax purposes. So what about non-resident? Well, if you are not a U.S. citizen, you are not a green card holder, you did not satisfy the substantial presence test, then you are considered non-resident for tax purposes. There is a big difference of being a resident and non-resident when it comes to U.S. taxation. If you are a resident for U.S. tax purposes, your worldwide income is subject to U.S. tax, and that means that you have global exposure for all your bank accounts and assets, being a resident for U.S. tax purposes. On the other hand, a non-resident, you are limited to U.S. footprints, meaning you're only taxed on your U.S. source income. So it is really important that you are aware that there is this substantial presence test that if you meet, you could be subject to a worldwide income taxation when it comes to the U.S. The worldwide income trap. So there's a global exposure for a resident taxpayer. Because U.S. tax residency isn't just about paying tax on your salary. It triggers complex reporting requirements. For example, you could be required to file FBAR, foreign bank account reporting, or you could be required to comply to report your non-U.S. corporations or other entities, or your investments could be subject to U.S. taxation, especially if they are considered PFICs or mutual funds, because failure to report these foreign assets often leads to higher penalties than the actual tax owed. Actually, those disclosure returns foreign bank account report, or the non-U.S. corporations for controlled foreign corporations, and PFIX, those forms are subject to very huge penalty if it's not done and filed correctly. So what do we mean when we say substantial presence test? Well, the Internal Revenue Service does not care about your intent. They care about the calendar. They care about how many days you were in the United States for the last 3 years, including the current year. So you need to be aware of this mathematical formula. You need to learn the math before it counts against you. So here's the IRS residency math. There is what we call the 31-day rule. What it meant is you must be physically present in the United States for at least 31 days in the current year to trigger the residency calculation. So that's the number one. And we have the 183-day formula. This is a rolling 3-year weighted average that determines if you have substantial presence in the United States. When counting the days for this formula, the 183-day formula, even a partial day is considered a full day. So the Internal Revenue Service counts any part of a day, even an hour, as a full day of presence. So layovers can be a dangerous trap. So it is important that you list all the dates that you were in the United States for the last 3 years. So how does this formula look like in a practical application? So the 3-year look-back formula for a current year, say for example for 2025, every day is counted as one. Okay? And then you need to look for the last 2 years, the prior years. So if you were in the United States, for example, for the current year, 2025, for 31 days, so all the 31 days is going to be counted as part of the 183-day summation. Now, we look back on the 2024. Say, for example, you were also in the United States for 330 during 2024. That 330 total days in 2024 is to be divided by 3. So 1/3 of your total days of the prior year, the 2024, is counted towards that 183 days. So if you were there in 2024 for 330 days, 110 of days of the 330 days is to be included when counting for the 183 days. Then you need to look 2 years prior. So the 2 years prior is 2023. So let's say, for example, you were also in the United States for 300 days during 2023. That means that 300 days is to be divided by 6 because 16% of the total days on 2023 is to be counted as part of the 183 formula. So let's have a look for our example. If you meet the substantial presence test using this 3-year look-back formula. So you were there in 2025 for 31 days. And in 2024, you were there for 330 days. So 110 days is counted with the 31 days. So that makes 141 days. And in 2023, you were in the United States for 300 days. 16% of that is 50 days, because 300 divided by 6 is 50 days. So 31 plus 110 for 2024 plus 50 in 2023, you meet the substantial presence test, because the total number of days using the 3-year look-back formula is 191 days. So what it meant is that you are considered U.S. resident for tax purposes by passing the substantial presence test, by spending more than 183 days in the United States for the last 3 years. What is the common logic mistakes that I have found and often seen on the last 15 years that I'm doing this expat cross-border taxation? Well, some of the taxpayers think that because they're already on B1 or B2 visa, they are automatically considered non-resident. Well, that is not entirely true. Immigration status does not determine tax status. The clock ticks regardless of the visa sticker. So if you are holding a B1 or B2 visa, make sure that you are aware that there is this substantial presence test. List down all the dates that you are in the United States for the last 3 years. Another common logic mistake is that I travel back and forth frequently. So, because I don't stay there that long, surely I am a non-resident. Well, short trips add up quickly in the 3-year weighted formula. So if you are frequent flyers, you need to make sure as well that you will not have a total of 183 days spending your time in the United States for more than 183 days for the last 3 years, based on that 3-year formula that we discussed about. Otherwise, you will be a U.S. resident because you passed the substantial presence test. Another common mistake is that I don't have a U.S. house or bank account. So, the Internal Revenue Service doesn't care where your assets are. The IRS only care where your feet were in relation to substantial presence test. Presence test. Another common mistake, I'm only here for a few months. Again, a 4-month stay every year for 3 years may trigger the 183-day rule. Well, it's just very close. If you stay in the United States for the last 3 years, every year, 4 months, 4 months, 4 months, then you've got 120 in the current year, 40 days in prior year, and 20 days only for the last 2 year, the prior 2 years. So your total in relation to that formula is only 180. So it's close. Okay. So here's the real world scenarios. Those individual that can be caught in the substantial presence test. The consultant. If you are a professional flying to San Francisco quarterly and you hit the 3-year limit, then you accidentally exposes your worldwide income to U.S. tax. If you are also a business person or a digital nomad, bouncing between cities and losing track of the rolling count, then suddenly tax residency triggers massive FBAR penalties on foreign accounts. So you also need to make sure that you are aware of the substantial presence test, and that you are listing down the number of days that you are in the United States. And also, there could also be a state tax filing obligations associated to your number of days in the US. But we are not discussing on state tax implications in this presentation. But I just wanted to make you aware of that. Another individual that could be trapped for the substantial presence test, if they are not aware, are the visa holder, like the students who's transitioning to work visas, who don't realize their exempt status has now run out. So if they are not aware of that and they continue to stay in the United States with a different visa because they transitioned from student to another visa, this could lead to backdated residency claims. So just be aware of those. Now, what are the risks of error? Well, getting your residency status wrong isn't a typo. It's a fraudulent filing in the eyes of the Internal Revenue Service. So you could be subject to penalties for failure to file disclosure returns or reporting your worldwide income if you are considered a U.S. resident for tax purposes. So beyond money, tax noncompliance may lead to visa revocations and inadmissibility during future immigration applications, especially if you wanted to apply for a green card in the future. There is a deeper compliance nuisance in relation to substantial presence test. I wanted you to be aware that the substantial presence tests and other IRS residency rules involve nuanced calculations and exceptions, such as the closer connection exception or treaty tiebreaker rules. These are not fully detailed in this summary. I will be presenting a separate webinar in relation to closer connection exception or claiming the treaty tiebreaker rules position. Determining your actual tax status requires a formal review of your specific travel history, visa type, and global financial ties. So it is important that you seek a proper advice from qualified tax professional in relation to your U.S. tax residency. Stop guessing. Get certain and clarity. If you have spent more than 31 days in the U.S. recently, your tax profile has changed. Protect your global wealth today. Book consultation at hello at usautax.com. I repeat, our email address is hello at usautax.com. We can help you review your travel logs, your visa history, and income streams to create a definitive roadmap for your U.S. tax compliance. Please note, this is not a tax or legal advice. The information provided in this presentation is for general information purposes only and does not constitute legal, tax, or financial advice. Tax laws are complex, subject to change, and vary based on individual circumstances and jurisdictions. While we strive to provide accurate and up-to-date information, USAU Tax makes no representations or warranties of any kind, express or implied, about the completeness, accuracy, or reliability of the content provided herein. Any reliance you place on such information is therefore strictly at your own risk. Transmission of this information is not intended to create, and receipt does not constitute an accountant-client relationship. You should consult with a qualified tax professional or legal counsel regarding your specific situation before taking any action based on the information in this presentation. Thank you so much for joining me, and I'll see you on the next webinar.